Let me be absolutely direct with you right now, and I want you to listen carefully because I am not going to repeat myself. Somewhere out there, right now, a regulatory door has been cracked open by the President of the United States. And behind that door sits a market that Wall Street has already valued at $400 billion. $400 billion. And while you were busy scrolling through headlines about tariffs and interest rates and whatever, the news cycle decided to panic about this week. The smart money, the institutional money, the money that actually builds generational wealth, was quietly positioning itself in three small biotech stocks that most people have never heard of. I have spent decades watching ordinary people miss extraordinary opportunities, not because the opportunity wasn't in front of them, but because they were looking in the wrong direction. This is one of those moments. Pay attention or pay the price later. Those are your only two options. Now, before I go any further, I need you to do one thing. Hit that subscribe button right now. What I am about to give you over the next 25 minutes is the kind of market analysis that hedge fund analysts charge their clients thousands of dollars per hour to hear. You are getting it completely free, but only if you subscribe. This channel exists for one reason: to hand ordinary people the same financial intelligence that the wealthy use to stay wealthy. Subscribe, turn on the notification bell, and let's get to work. On April 18th of this year, Donald J. Trump signed an executive order, and I want you to understand what that sentence actually means in practical financial terms, because most people read the word executive order and their eyes glaze over. They think politics, I think money. When a sitting president of the United States puts his signature on a document that fast-tracks an entirely new category of medical treatment, designates certain drugs as national priorities, and immediately backs that declaration with $50 million in federal research funding, he is not making a political statement. He is opening a market. He is removing the single biggest obstacle that had kept an entire pharmaceutical category frozen in regulatory limbo for the better part of 40 years. The category in question is called psychedelic-assisted therapy. And before you switch off, because that sounds like something from a 1960s commune, I want you to stay with me, because the business case here has nothing to do with counterculture and everything to do with cold, hard mathematics. These are not street drugs handed out at a festival. These are synthesized, laboratory-produced compounds administered in a clinical setting by licensed medical professionals. The day after Trump signed that order, three small biotech stocks, Compass Pathways, ticker CMPs, Atai Life Sciences, ticker Atai, and GH Research, ticker GHRS, jumped between 20 and 50% in a single trading session, a single day. And then the news cycle moved on, as it always does. And most retail investors forgot about it entirely. That is the pattern I have watched repeat itself throughout my entire investing career. The crowd chases the spike, panics when it fades, and abandons the position right before the real move begins. The real move in this sector has not happened yet. The regulatory foundation is being built right now. The clinical data is being compiled right now, and the institutional money is accumulating right now, quietly, patiently, and without any of the fanfare that tends to attract the wrong kind of investor. What Trump's order also did, and this is critically important, is signal political alignment from both sides of the aisle. You have RFK Jr. sitting at the head of the Department of Health and Human Services, actively championing alternative and innovative medical treatments. You have bipartisan legislation being introduced in Congress to address the mental health crisis among veterans, among trauma survivors, among addiction patients. When Republicans and Democrats agree on something in today's political environment, that is not a coincidence. That is a freight train leaving the station. And you need to decide right now whether you are on it or watching it leave. Now I need to show you something that I consider the most important data point in this entire analysis, because everything else I am going to tell you about these three small companies rests on a foundation that has already been proven by one of the largest corporations in the world, Johnson & Johnson. Yes, the company that makes baby powder, the company that most people associate with Band-Aids and shampoo. In 2019, Johnson & Johnson received FDA approval for a drug called Spravato, which is a nasal spray version of a compound called esketamine, and it was designed specifically for patients with treatment-resistant depression, the same patient population that the three companies I'm about to introduce you to are targeting. When this drug launched, the financial press destroyed it. The headlines were merciless: $590 per dose, and patients needed it twice a week for the first month. The UK's healthcare watchdog refused to cover it and called it too expensive. Analysts said insurance would never pay for it. Wall Street largely dismissed it as a failed experiment that would quietly disappear from Johnson & Johnson's pipeline within a few years. I want you to remember those headlines, because here is what actually happened. In the first quarter of 2026 alone, Spravato generated nearly $500 million in revenue, which represents almost a 50% increase over the same quarter the previous year. On an annualized basis, this drug is now doing close to $2 billion per year. Bloomberg has already labeled it Johnson & Johnson's blockbuster psychedelic drug. The insurance companies that were never going to pay for it are paying for it. The patients who are supposedly never going to seek this treatment are seeking it in massive numbers. The market that the experts said did not exist has turned out to be enormous and is growing at nearly 50% per year. This is what I call proof of pudding. This is not a theory. This is not a projection. This is a real drug generating real revenue inside a real company, proving that the market exists, that patients want the treatment, that insurance companies will cover it, and that you can charge a premium price for it. Now, here is where mathematics becomes genuinely exciting, and I want you to follow this logic carefully. Johnson & Johnson is currently a company worth somewhere in the neighborhood of $400 billion. When Spravato adds $2 billion in annual revenue, it barely registers as a rounding error on their income statement. I made approximately 45% on my position in Johnson & Johnson last year, which I am perfectly happy with, but the drug is not going to 10 times Johnson & Johnson's stock price. The company is simply too large for a single drug to move the needle that dramatically. But now I want you to apply the same mathematics to a company worth approximately $1 billion, Compass Pathways. The first stock I am going to walk you through in detail is sitting in a market capitalization of roughly that size right now. If their lead drug, COMP360, does even half of what Spravato is doing, half, not equal, not more, just half that means approximately $1 billion in annual revenue flowing into a company currently valued at $1 billion. Pharmaceutical companies with patent-protected drugs typically trade at 5 to 10 times their annual revenue. Run the calculation yourself. $1 billion in revenue multiplied by 5 times revenue multiple gives you a $5 billion company. At a 10 times multiple, you are looking at $10 billion. The stock is sitting at around $10 right now. You do not need a PhD in finance to understand what those numbers mean for early investors who have the patience and the discipline to hold through the uncertainty. This is the blueprint. Johnson & Johnson has already drawn it. Now, 3 smaller companies are attempting to build on top of it. Before I take you through each company individually, I want to make sure you understand the demand side of this equation, because without demand, none of the mathematics matter at all. There are 280 million people on this planet living with serious depression. That is not a statistic I am making up. That is a documented, globally recognized public health crisis, and it has been getting worse, not better, for decades. Of those 280 million people, approximately 85 million of them are classified as treatment resistant. This means they have tried the standard medications, the antidepressants, the SSRIs, the variations and combinations that the psychiatric industry has been prescribing since Prozac arrived in 1987, and none of it has worked. They have endured the side effects, the weight gain, the emotional blunting, the dependency, and at the end of all of that suffering, the illness remains. system has been giving these people the same answer in slightly different packaging for nearly 40 years, and 85 million of them are still waiting for something that actually works. And that is only the depression population. And layer on top of that, the veterans returning from combat with post-traumatic stress disorder so severe that the standard treatment protocols fail them consistently. Layer on top of that the anxiety epidemic that is currently consuming an entire generation of young people at a scale that the mental health system was never designed to handle. Layer on top of that addiction, opioids, alcohol, behavioral addictions, conditions that psychedelic-assisted therapy has shown measurable efficacy against in early clinical data. All of these patient populations are converging on the same unmet medical need, and the pharmaceutical industry, which exists to generate profit by solving medical problems, is now being given regulatory permission to solve this one. Wall Street has looked at all of these numbers, the patient counts, the willingness to pay, the insurance coverage, the precedent set by Johnson & Johnson, the bipartisan political support, and the historical underinvestment in this category, and they have landed on a figure of $400 billion as the total addressable market. $400 billion. To put that in perspective, the entire global video game industry is worth approximately $250 billion. The market for mental health treatment that currently has almost no effective options for 85 million people is larger than that. And right now, the companies positioned to capture a meaningful slice of it are trading like forgotten lottery tickets. That combination, massive addressable market, proven demand, regulatory tailwind, and deeply discounted small cap stocks, is exactly the setup that has produced the most extraordinary investment returns of my career and the careers of every serious investor I have ever known. Now let us get specific, because specificity is where most financial commentary fails the investor. I'm going to walk you through all three companies using a framework I want you to memorize and apply every single time you evaluate a pharmaceutical or biotech investment. Three filters. First, gross margin, which is simply the percentage of every dollar of revenue the company keeps after the cost of producing the drug. For a patent-protected pharmaceutical, you generally want to see 70% or higher. Anything below that suggests the drug is commoditized or the manufacturing process is inefficient. Second, patent duration. How many years of legal protection remain before a competitor can legally copy the formula and destroy the pricing power? 5 years is insufficient. 15 years is acceptable. Anything longer than that is genuinely valuable. Third, and most important, is the drug currently generating revenue. I have an inherent bias toward companies that are already selling something over companies that are still running trials. And I want you to understand why. Trials are binary events dependent on regulatory decisions that no one can fully predict. Revenue is evidence. Revenue is proof. Revenue tells you that the market exists, that the pricing works, and that the commercial infrastructure is functioning. When you invest in a pre-revenue biotech, you are not investing in a business. You are making a calculated bet on a specific future event, and you need to size that bet accordingly. I will come back to sizing in a moment. Compass pathways, ticker symbols, CMPs, is where I want to spend the most time, because it represents the clearest and most advanced opportunity in this category. Their lead drug is called COM360, which is a synthetic version of psilocybin, the active compound in what are commonly called magic mushrooms, and it has been specifically engineered and clinically tested for treatment-resistant depression. The same 85 million person patient population that Johnson & Johnson's Spravato is already successfully monetizing. Compass has completed phase 3 clinical trials, which is the final hurdle before FDA approval. And the data they have generated falls within the ranges the FDA has historically accepted. This means we are looking at a plausible FDA approval window somewhere in late 2026 or early 2027. If that approval comes through, Compass becomes the first company in history to have a classical psychedelic compound approved by the United States Food and Drug Administration. That is not a minor achievement. That is a landmark event that will reshape the entire mental health pharmaceutical landscape. Now, run the framework, gross margin. They're not selling yet. So we have no current data. That is a failure on filter one. And you need to sit with that honestly, rather than explaining it away. Patent situation. They hold multiple patents covering the formulation, the dosing protocol, and the manufacturing process, which is a reasonably strong position. But the real test of patent protection always comes when a competitor challenges it in court. And that has not happened yet. Is it selling? No. So by the standards of my three-filter framework, Compass fails on 2 of the 3 criteria right now. I am telling you this, not to discourage you, but to be completely transparent, because the people who get hurt in these situations are always the ones who convince themselves that the risks were smaller than they actually were. The stock chart tells a story that most people find discouraging, but that I find genuinely interesting. The company listed around 2021 at prices near $60 per share. It subsequently crashed approximately 83% to below $4. It is now trading around $10. Most investors look at that chart and see a disaster. I look at it and see a company that went through the exact same cycle. I have watched dozens of innovative companies go through over 60 years of investing. Enormous initial enthusiasm, brutal disappointment when reality proves slower than expectation, years of neglect and boredom, and then for the companies whose underlying technology or product is genuinely valid, a recovery that ultimately exceeds the original peak. And the key question is whether the underlying science is valid. And in Compass's case, the phase 3 data suggests it is. ATI Life Sciences, ticker symbol ATI, is a fundamentally different kind of bet. And I want you to understand the distinction clearly. Where Compass is a concentrated, single drug wager, ATI is what I would call a platform bet, or more precisely, a diversified pipeline bet. They are a clinical stage biotech company running 5 separate drug programs simultaneously across different compounds and different therapeutic targets. They also merged with a company called Beckley Psytech, which broadened their pipeline further. Peter Thiel, who built PayPal and was one of the earliest investors in Facebook. And Palantir is a significant backer of this company. And ATI also holds a stake in Compass Pathways and licenses Compass's drug for certain geographic territories. This means that if you buy ATI, you get partial exposure to the Compass's seas as well, which some investors will find attractive as a form of built-in diversification. The commercial model they are developing is also notable because several of their drug candidates are being designed to be administered outside of a clinical setting, which would dramatically reduce the cost and logistical complexity of delivery compared to Compass's 6 to 8 hour supervised clinical sessions. Run the framework on ATI. No meaningful sales till filter 1 fails. Patent protection exists across 5 separate compounds, which is structurally better than a single compound because failure in one program does not necessarily invalidate the others. No current revenue, 2 or 3 filters fail. Same as Compass. The stock chart shows the identical pattern. A run up to $23, a collapse back to mere listing price. And now the beginnings of a recovery. The position sizing logic I will give you in a moment applies equally here. GH Research, ticker symbol GHRS, is what I'm calling the technology bet. And it deserves attention for one specific reason that I think most retail investors are not thinking about carefully enough. Their lead compound is a psychedelic called 5-MeO-DMT, which operates through a completely different mechanism than psilocybin and, critically, has a dramatically shorter duration of action. Compass's COP 360 requires a 6 to 8 hour supervised clinical session, which creates enormous scheduling, staffing, and real estate cost pressures for any clinic trying to build a commercial practice around it. GH Research's compound potentially delivers a therapeutic session in as little as 30 minutes. Think about what that means from a pure business economic standpoint. A clinic that can deliver 6 to 8 treatment sessions per day per treatment room versus 1 session per day per treatment room has a fundamentally different revenue model and a fundamentally different ability to scale. If the efficacy data holds up and the FDA approves it, GH Research's compound could be dramatically easier and cheaper to commercialize than any of its competitors, which would make it the preferred treatment option for the clinics and health systems that ultimately control patients. DIAM. The framework applied to GH research produces the same result. No current sales, single compound patent risk, no revenue, and the risk profile is the highest of the three, but the potential commercial differentiation is real and worth understanding. Now, I need to talk to you about something that most people who make videos about exciting small cap stocks conveniently leave out, and that is risk management. Because without it, every single thing I have told you up to this point is just entertainment. It is a story. Stories do not build wealth. Disciplined, mathematically sound position sizing builds wealth. Here is the rule I apply to calculated speculations of this type, and I want you to write it down and follow it without deviation. 1 to 3% of your total investable portfolio spread across the entire category, not 5%, not 10%, certainly not everything I have saved for the last 3 years, 1 to 3%. Here's why this number is not arbitrary. If every single one of these companies fails completely, FDA rejection, clinical trial collapse, political reversal, competitor dominance, and all three stocks go to zero, you lose 1 to 3% of your portfolio. That is painful, but survivable. You still retire, you still eat, you still function financially. Now run the other scenario. If even one of these three companies achieves half the commercial success that Johnson & Johnson's Spravato has achieved, and the mathematics I walked you through earlier plays out, a 1 to 3% position becomes a 10 to 30% position in your portfolio. At that point, you have a different kind of problem, which is knowing when to take profits. And that is a problem I am more than happy to help you have. The risks here are real, and I will not minimize them for you. FDA approval is not guaranteed. Compass's data is encouraging, but regulatory decisions are never certain, and a rejection or a request for additional trials would be devastating to the stock price. Capital dilution is a near certainty at some point. These companies will raise money before their drugs generate meaningful revenue. And every time they issue new shares, your existing shares represent a smaller percentage of the company. The commercial launch could underperform expectations even with approval, because turning a clinical success into a commercial success requires building sales forces, negotiating insurance reimbursement, training physicians, and scaling manufacturing simultaneously. And the political environment, while currently favorable, is not permanent. The same executive order that opened this door can be modified, redirected, or reversed by a different administration or a different political priority. None of these risks are reasons to avoid the category entirely. They are reasons to size it correctly, enter it with clear eyes, and establish in advance the conditions under which you will exit. I want to leave you with a challenge. And I mean that word in its truest sense, because a challenge requires a response, and a response requires a decision. And a decision is the one thing that separates the people who build wealth from the people who spend their lives watching other people build it. You have sat through this analysis. You have heard the mathematics. You have heard the Johnson & Johnson proof of concept. You have heard the $400 billion market size. You have heard the 85 million patients who are waiting right now for something that works. You know the three companies. You know the framework. You know the risk. You know the position sizing rule. The only question left is what you are going to do with all of it. And that question will tell you everything you need to know about your financial future. The people who take this information, apply it with discipline, size it correctly, and monitor it patiently are the people I have watched build extraordinary wealth from ordinary starting points over my entire career. The people who nod along, find it interesting, close the video, and do nothing are the people who will be watching a different video in 3 years about how they missed the psychedelic medicine market, just like they missed quantum computing, just like they missed the AI infrastructure build out, just like they missed every other generational opportunity that passed in front of them while they were waiting for certainty that never comes. Certainty is not for sale in the investment markets. Calculated, disciplined, informed action is all there is. Now go take it.